Hello Sector Watchers, welcome to the show. This is the 63rd episode of Sector Spotlight on Tuesday the 19th of January, recording it on Monday the 18th. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands, where it is very wet and rainy and cold. We're longing for spring and a little bit of sunshine over here. Martin Luther King Day today, so those of you who didn't have to work, I hope you had a very great day off, and it means that we can have a proper look at what happened last week because we don't have the rolling over into Monday effect for our overview. That's what we're going to do. We're going to take a look at the rotations that were visible in various asset classes as well as in US sectors last week. We'll be trying to put those into a little bit longer term perspective as you are used to. And then after the break, we'll have two questions from the mailbag, which I think are very interesting. At least one of them is very interesting. And if time permits, then we'll have a quick look at the long short basket and one change, especially on the short side. So let's get started with the rotation in asset classes last week. We'll have the RRG chart on the left for those asset classes and ranked on performance. And as you can see, the Vanguard Real Estate ETF actually did very well with a 1.9% gain. And the weakest asset class last week, it's been a long time since we saw that, was the stock market, dropping 1%. The benchmark or benchmark down 60 bips, VBINX, which means that all the others were above, and you can see that the spread, the difference between the highest and the lowest performance of that week wasn't all that big. Pretty good week for DJP commodity index. The GSCI, the more energy weighted, still gained 20 basis points, and obviously the fixed income complex, so GOVT, LQD, which is corporate bonds, and HYG, which is high yield corporate bonds, are still above the VBINX to offset the losses in the stock market. If we look at the rotation, then we can see that the week started off pretty well for stocks and then rolled over for the last 3 days. Sort of the same picture for commodities, and all the others are still inside the lagging quadrant and pushing further down. It's very interesting to see that there is not a single asset class that is actually picking up relative momentum to that benchmark, which is interesting. So I think, I haven't seen that very often, but I think that what we'll have to see is that either the asset classes right here will have to pick up the pace and start moving up on the RS momentum scale, or the ones in the leading quadrant will curl back and continue their way deeper into the leading quadrant. But this is what it is for now. If we move over to sectors, then immediately XLE energy catches the eye because this is a big fat tail. If you remember the presentation or the interview that I did with Charles Brown of CB3 Financial, he talked about big fat tails moving into the northeast direction. Well, here you got one. This is XLE, big fat tail, and the fatness comes from the thickness of the tail. Compare the tail here on XLE with the thickness of, say, utilities and industrials, and the difference is caused by the distance from the benchmark. So XLE is very far away, which means that it gets a fat tail, a thick tail, where XLI is very close to the benchmark or a lot closer to the benchmark, and it gets a much thinner tail. The reason for that is that under normal circumstances, stuff that is far away, and it doesn't matter whether it's in leading or lagging, far away from the benchmark, those sectors, those tails, usually have a higher probability of capturing alpha because they're so far away from the benchmark. They have to make a big move to get back to the benchmark and maybe move the other way. So it gives them a good source of alpha. Anyway, energy Very nice one. And then here we got materials and financials doing the same, not as nicely rotating as XLE. They're rolling over a little bit. If we look at the performances, then energy obviously the winner with a 3.2% gain. Real estate doing very well, but if you look at the position on the RRG, it's the weakest. Similar that we saw here in asset classes. We saw V&Q doing very well, but on the RRG, it's well inside the lagging quadrant and moving further into it. So for the real estate sector and asset class, I'm seeing this as a little bit of a recovery rally within a longer term downtrend. We see utilities picking up a little bit, but there also you see that we'll see that on the longer term trend that utilities is still one of the weaker sectors. We got financials continuing very nicely. Second strongest sector in the universe for now. And then industrials lost 0.9, still above the benchmark because SPY lost 1.5% last week. I can't remember actually when was the last time that I had to tell you that that SPY had a negative week. So it's been quite a while. Materials minus 1.5 in line, and then we have technology and communication services, our leaders for a long time, now at the bottom of the list with a respective minus 2.6 and minus 3.3% return. I'm going to move this chart here to the left, and I'm actually going to skip the asset classes because you didn't see a lot of changes there. I'm going to quickly take a look at the weekly charts for a few of the sectors. There's one chart in asset class that I want to show you. That's golf. That you can see here is that has now really rolled over. That is now really a top formation in place. Dropped below important support on its relative line, pushing further into the lagging quadrant. So despite the relatively strong week for golf this week, I think that the longer term trend for government bonds is still lower, which means that we keep a preference for stocks over bonds at this point in time. Let's move to the various sector charts. Let's just see what we can do here. Let's just walk the way here. So we'll start with energy. That is now seriously improving. The one thing that is holding it back is this resistance area between 45 and 47.5, and the fact that we still have this long-term downtrend in play. Obviously, the relative strength trend was down, so we kept it. People who regularly watch the show know that I've been, with holding back on really calling energy upward. And I'm still somewhat reluctant because of this overhead resistance, and we had a very big rapid move that you see here. So if you play that, well done. The longer term trend, I believe, needs to see a break above this resistance area, and there, from a relative point of view, I think there is more than plenty in store when that really starts to play out, because you can see how long that relative downtrend is in play, and we can expect, if that trend really turns around, a long-term period of relative outperformance for energy going forward, if and when we can actually take out that overhead resistance between, let's say, 45 and 47.5. Go to materials. That is a sector that is on our buy list and our strong list for quite some time. There's no reason to change that. You see a little bit loss of momentum here on that tail, and that's because we sort of moved flat here in the RS ratio. The break is still there, the trend is still upwards, so I'm still very confident that materials will continue to do pretty well in the next few weeks. And then we have financials, and what you can see here is that, and there's one thing that I want you to know. I switched to the unadjusted series for financials here, because dividends have a big impact on this ETF. And if you look at the unadjusted version, it looks as if we're breaking above that previous high, and that's a dividend effect. So if you look at the pure price, then we are right now bouncing against that former high. And I think that that is a more important level to watch. So I'm watching this very closely to see if we can actually take out that high. That would be obviously a very positive thing. And you can see that the relative strength is doing its best. It's really working to form a bottom here, and it's already being picked up by the RRG lines, and that's why XLF is actually pushing so fast into the leading quadrant. Definitely a very good sector, and it will even be better if we can take out 31.50, a convincing breakout above this high that we saw at the start of 2020. We got discretionary inside leading. We got that right here for you. And that is still a very strong sector. We lost somewhat relative strength. And let me put that on the weekly. That makes more sense, actually. You see that those are still the same. So here you got energy moving in there. You got financials moving in there. Just talked about that. We got materials. Very short tail, you saw that it's bouncing back up, and we're now here at consumer discretionary, which is starting to pick up a little bit of relative momentum. It's very good possible that it will continue its rotation and start to move back up. I mean, the price chart is still good, so the price chart is not holding back on that improvement in relative strength. If this continues, we'll see a very nice rotation back up for the consumer discretionary sector. Healthcare is quite different. It's here, healthcare trend pretty good at the bottom of the trading range in relative strength, but the RRG lines are pretty much going nowhere. And the one chart that is interesting to keep an eye on here is the RRG for healthcare stocks, so the individual healthcare stocks, because what you see, this is all over the place. And now look at when you compare XLV with or change XLV into SPY, you see hardly any difference. It's all over the place. So this sector is very diffuse. It's very spread out, which means to me a lot of uncertainty. I mean, if you would have a strong bias or a strong direction of this sector, then when I would change the benchmark to SPY, I would expect a bias towards the leading or the lagging quadrant, but it's not happening here. If you do XLV or SPY, it doesn't really make a lot of difference, which is exactly what this is saying. It's almost flat versus the benchmark, and that positions healthcare inside improving and rolling over. Technology continues to deteriorate, so we still have to be very careful with that one. You see that it's in that range here around the strength, but the fact that it's not picking up and continuing to move sideways is pulling that RS ratio further down. I think if we see some sort of a toppish formation here, and if we break below this area here, that's 124, 125, and we start to move lower, that tech could be in for a little bit more damage to the downside. What else? Let's look at utilities and staples, because these are really the weaker sectors in the universe right now. So if we look at utilities, then you see that the relative strength is moving lower. We just moved below its previous low, so that move is definitely going further down, and you see that it's being picked up by the RRG lines. The trend, because it's so shallow, is still upward, higher highs, higher lows, but it's just not fast enough to keep up with what we see in SPY. And if we move to consumer staples, and let's make that the last one before the break, then we'll see a sector that this one is actually rolling over. You see very weak relative strength. This is now really confirming a relative downtrend picked up by the RRG lines. But what's more important, you see a really toppish formation here, and let me zoom that out a little bit. Let's go for 7 days. Why not? and you will see, or 7 weeks it's actually, you see that this is now really rolling over here. This is a very tired chart, I would say. So if let's take this low here, that was 65.50. If we break below that, I expect this to accelerate lower and push relative strength even further down. This is absolutely moving further into the lagging quadrant. So this is it for quick overview, putting especially the sectors into a little bit longer term perspective. The main trends remain intact. Financials and energy continue to steal the show. They're the strongest. We got good rotations for industrials and materials, short tails on the right hand side going back up. And then we have communication services, tech losing it. A little bit of that for discretionary. That might be in for a curl up, but we'll keep an eye on that this week and we'll talk about it next week. And then be very careful with staples and utilities and real estate as well as healthcare. We're going for a quick break, 30 seconds. We'll be back after that and we'll talk about a few questions in the mailbag. And welcome back. The first question that I want to talk about in the mailbag is this one that you see on your screen right now. It says, "Hello Julius. First of all, I love your work, and I love to hear that. Referring to your recent article on StockCharts, I'd like to try this with other sectors. It seems I can find the symbols for industries like $DG USSW, but I don't know how to find a list of S&P industries in a sector, like $GSPSW in technology as you did. Can you help? Thanks, Stuart." Yes, I can. What the article that Stuart is referring to is this one from November. And what I did here is I broke the technology sector down into the S&P industries. Now you may know that on the site, on StockCharts, we usually use the Dow Jones industries. So you will find those on a number of places. For example, if you go into the sector summary, you may know, or maybe not, and then you'll learn something today. See this RRG icon at the end of each line. If you go to technology and you click on that RRG icon, what will happen is that it will open up an RRG with the industries, with the Dow Jones industries that make up the technology sector. Now, there's a little bit of a inconsistency because the sectors are the XLC, XLB, XLK. Those are based on the S&P sector breakdown. And the industries use the Dow Jones breakdown of sectors and industries. So there's a slight mismatch. There's a lot of reasons why that is. We won't go into that right now, but that is the setup. That is what we have to live with. It's super helpful because it will give you a more granular and a more detailed breakdown of a sector. And there can be very big differences between those industries inside a sector. So if you want to use the standard layout, the standard breakdown, then the Dow Jones industries are at your fingertips for every sector just from the sector summary page. So you go to Staples, then just click on it and you will find everything that is part of Staples. Utilities, you will find all the industries that are part of, in this case, utilities. This is a good example because what you will see here is that they're all going down. That's because the benchmark is by default the S&P 500. If I would make that XLU in this case, I would get a better RRG, which will show you the rotation of the various industries versus the sector benchmark. This is for Dow Jones. Now, Stuart asked, how can I get to the breakdown of the S&P groups, the S&P industries? For that, they are on the system, but they're a little bit hidden. And the best way to do it, you can start here, but what I've found is that the symbol catalog is a very powerful page. And if you go there, you may have noticed that all these symbols are starting with $GSP. So if you do that, you will find all the ticker symbols that start with $GSP. If you know that there's about 100 of them, I think, that are all, breakdowns of the various sectors at a higher level. What you also may know, and then you get a little bit more granular, is that they all have S&P 500 and industry index in there. So if I would go into the catalog and type S&P 500 industry index and then hit enter, now I got everything that has S&P 500 industry index. And these are all the S&P industries. And you will note that some of them even have the industry groups that are also available. That's even one level higher. But this is the way, Stuart, how you can find all the S&P industries that make up the various sectors. I will try to see if I can get this field filled, which would make it easier to grab them down and wrap them up in a sector. Because, don't know about you guys, but I certainly don't know about all these individual sectors or industries to which sector they belong. You can think about it and maybe, but sometimes it's not very clear. So it would be helpful if we could fill this, and I'm gonna talk to the data guys and see if I can get that field filled so we can actually sort it down by sector and see the breakdown in industries. So I hope that answers this question here. Now, the second question is a long one, a longer one, but it's very interesting. Julius, I need your thoughts and guidance. I invest with 100% individual stocks in my IRA. I have enough in the account to diversify into each S&P sector and subsectors with these individual stocks. Been pondering using some ETFs that represent the sector and reduce some of my individual stocks. I have so many individual stocks, it is hard for me to review each chart, the RRG and the seasonal information each month to make any adjustment on all of these stocks. I have missed opportunities to rotate into improving and leading sectors on a monthly basis. I'm using individual stocks to be a bit more aggressive and get more return than an ETF. But it makes me less nimble to use RRG and seasonal in a timely manner. In theory, with a more nimble, using more ETFs, less individual stocks, using RRG and seasonal to make adjustments perform better than holding 100% individual, which is many, stocks and being less nimble for RRG movements. Obviously, this is not a yes and no question. This is more a question that for me goes into the category of portfolio management, portfolio construction. And I don't know if going to use more ETFs and use RRG and seasonals will lead to a better performance. Obviously, you still need to pick the right ETFs. But what I can say is that I can totally relate to the fact that if you have a very big portfolio with a lot of individual stocks, that it is a lot of work. It actually becomes almost a job. That's why portfolio managers at RIAs or institutions or pension funds is actually a full-time job, because they have such large portfolios with so many names in the portfolio that it requires a lot of time. So if it's not your daytime job to invest, and you have other things to think about, then I can totally agree that having a very big portfolio with individual stocks just takes up too much time and you will miss opportunities. So for me, this is more a question of risk and reward. And I think running a very big portfolio with a lot of individual names without being able to dedicate the proper amount of time is pretty risky because you will miss opportunities, but you will also miss reasons to get out of individual stocks. And obviously with individual stocks, you're more aggressive, you have better opportunities, but you will get undoubtedly more risks, more single stock inherent risk. So what I would advise Michael and everybody who's in the same situation, because I'm pretty sure Michael is not the only one, is to work with what is called a so-called core satellite approach. So you build your core portfolio with a few ETFs of sectors that you feel are outperforming. You can use RRG. Obviously, I like to use RRG for that, but just as a philosophy, as a process, just build your portfolio with a number of sector ETFs. So that gives you that you're in the right direction. Now, you can then start to dive into individual stocks, maybe of those sectors that you already have. So let's say that you have a holding in, okay, let's say technology, easy. So you got a holding in technology, and you put that into an ETF. So part of your portfolio, certain percentage, is in the XLK ETF. Now you can look inside that XLK ETF and look for a couple of names that you feel would be doing really well, outperform XLK. You could buy then a little bit smaller position in those individual stocks. So you've got XLK, which is your core, and you can have some satellites of the ones that you think would be really powerful and really strong. Say Microsoft or Intel or whatever technology stock is good at that point in time. So then you'll have the technology sector with an overweight in Intel and Microsoft. And you can do the same with communication services or staples or discretionary or whatever. If you have XLY is part of your core holding, and you think that Amazon will be doing really well, you buy some extra Amazon. And then you get a portfolio which is, in the bottom line, very well diversified, because with the ETF, you essentially hold all the individual stocks of that sector, and you add a little bit of the ones that you feel are doing really, really well. I think I'm going to write this up in a blog article with some images and some pictures, because I think that it resonates with a lot of people how you can build a portfolio. It's not really RRG related, but I think it makes total sense. And RRG is a good tool to actually work with such an approach. Ladies and gentlemen, this was Sector Spotlight for this week already. Remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. If you like the show, please give us a like and a thumbs up down below. If you've got any questions, anything you want to share with us, please do it in the comment section below. I hope to see you again next week in the next episode of Sector Spotlight.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.